Thanks for joining my webinar. I'm Lyn Summers from Stock Course. Over the next 20 minutes, I will share with you very briefly what has happened in the past in this financial collapse, as we call it, stage one of it, what is happening now in the global markets, but more importantly, what is going to happen in the future. Yes, if we understand what is happening in the US, it gives us direction into knowing what's going to happen in the future. So today I'm going to show you how you can profit from this financial collapse, and also how you can profit from buying gold, and why these two are going in the opposite direction. So before we get started, our disclaimer first of all. All investing involves risk, and careful consideration should be taken before undertaking any investing decisions. You should seek independent financial advice from an appropriately licensed professional before you invest. This presentation in no way offers investing advice. The information in this presentation is designed for general education purposes only. Stock Course does not provide individual customized investment or trading advice. You like my picture of the bull? As you can see, he's still lying on his side. Yes, I'm going to show you now how we are still in a bear market. Yes, even though we've rallied off those March lows and the market's been going higher, I'm going to now show you how this is a bear market rally and forewarn you for what's happening in the future. Now, remember 2008 when the market collapsed? Yeah, and most of you guys become to realize that the collapse had hit us a year ago. October last year, when Lehman Brothers collapsed, everybody really took note that the market was massively collapsing. Well, we already knew that that was coming into the market 12 months before. You see, the first stage of these mortgage defaults that were hitting the market were called the subprime. You can see that they started to peak on that graph there, those green bars. The subprime peaked at the end of 2007. Now notice the next graph that takes us into the start of 2009, where we are now, right into 2011, where those yellow bars there are what we called option arms. Yes, these are Alt-A option arms, another lot of mortgages that are about to default in the market that nobody is talking about. These Alt-A option arms are mortgages that people took out. Remember, they weren't subprime, so they were mortgages that people took out that didn't have to have any credit checks. It was an easy way for them to get credit. Yes, when they signed that mortgage agreement, most people failed to see the fine writing on the bottom, the clause, that those option arms were about to reset. Now this is a very important factor here and right now, is because we have many US citizens that are foreclosing on their mortgages. They're walking away, aren't they, from their mortgages because they can't afford to pay them. Those people at the moment that are struggling at the moment with those monthly payments are about to be crunched with a higher monthly repayment. Well, if we all go back to the beginning of how all this started, yes, you see, an Alt-A mortgage, it allowed lots of families in the US to buy a more expensive house than they really could afford. There was no credit checks that they had to go through, so basically they could afford to own their own home. It was the American dream. So they could buy cheaper than they could pay rent. Everybody scrambled to get a house in the market, which fueled the housing bubble, didn't it? And of course we had these mortgage brokers, these hungry commission mortgage brokers that were unregulated to the financial health of all these buyers. Did you know that they originated 80% of all the mortgages that were written? Why did they do that? Well, greed. Because they were paid big bonuses for selling the most exotic products They had the highest bonuses paid to them. So of course they were pushing them. And then we have the banks. Why did they love these option arms? Well, an accounting rule is because they can book all of their earnings up front. Now remember, even though the borrower of that mortgage may never pay that loan in full, they can still book their earnings up front. Yeah, creative accounting rule. Well, they were known first of all as, they were produced as AAA rating. They are now deemed toxic. Have you heard that word in the market where they talk about these toxic assets? The banks have them all over their books, don't they? And of course, Wall Street was buying these mortgage loans aggressively. They were packaging them up and selling them as insurance. To explain this, it's a little bit like buying an insurance policy on your friend's new sports car. He writes that sports car off and you get to collect on the insurance as well as he does. Did you know that there can be up to hundreds of people that have the same insurance on that one product? So you can see how the collapse had a ripple effect, a devastating effect when it did take hold. These are known as credit default swaps. Heard that word before? A lot of people really don't understand what they are. Did you know that there's $58 trillion worth of these credit default swaps out there? It's an alarming amount. To show you how these option arms work, Countrywide Financial, well, they're no longer there, are they? They've gone bankrupt. But they were one of the first companies to initiate these loans. So let's say that you started off and took out a mortgage for $460,000. You were teased and given these teaser rates at a very cheap monthly amount that, hey, I can afford that. That's cheaper than I'm paying rent. Except when you hit the second year, the mortgage went up. The third year it went up, the fourth year it went up, and the fifth year it went up, and then it reset at double the amount. Those option arm mortgages now are starting to reset in their fifth year. So those people out there that have been struggling to achieve that monthly payment as it increases, all of a sudden in the fifth year, it doubles. You can see what's going to happen because what's been happening already, people have been walking away from their mortgages, hey. These are known as jiggle loans, where you can hand back the keys to the bank and walk away and be unobligated. Yeah. So what do you think they're going to do with these all-day option arms? If you can't afford to pay your mortgage in the States, you can hand back the keys to the bank and walk away. You can walk away with cash in your bank. You can walk away with other assets that you own. It's just that mortgage that you walk away from. Wow, if we did that in Australia, we'd go to jail, wouldn't we? Well, it's allowed to be done over there, and that's why they are walking away in droves. They can no longer afford to pay these mortgages, especially when they've taken out a mortgage on a $500,000 house that was valued that now has a new value of $250,000. Yeah, the value is actually halved. So why not walk away? So to fix the problem, remember at the beginning of this year in March when the whole market collapsed and our market in Australia came down to all-time lows, the Dow Jones came down to 6,500 points. That was from 14,000. Well, to fix the problem, the Fed started printing money, didn't they? Yes, they turned on their money machines and thought that they could just throw a ton of money at the problem initially. Now, this has some devastating long-term effects, which is why now I'm going to show you why gold now has no other way but to rise in price against the US dollar. Well, yes, Mr. Ben Bernanke, the chairman of chairman of the Fed, he's known as Helicopter Ben, is because that's what he's done. He's just taken all that money up into a helicopter and just let it all loose all over the US to